Ladies and gentlemen, welcome to yet another CNBC Africa special with me, George Ndirango. We'll be getting to hear from our industry players on what exactly the country and the region is doing to ensure that we cement our position on a global stage. And without any further ado, allow me to introduce the panelists for today, and then we'll create a bit of context. On the extreme left, we have Mr. Alistair Gold, CEO at African Alliance Kenya. Glad to have you with us. Next to him, we have Mr. James Moria, CEO of Centum Investments. Next, we have Jane Ngige, CEO of the Kenya Flower Council. Glad to have you here as well. And of course, Joe Onsando Group, CEO of Minet Africa. Now, with the branding, of course, we can tell that we're here, first of all, to congratulate Minet Africa and Minet Kenya on the growth that has been made. But we'd like to take the conversation further than Kenya, further than individuals, further than companies, to see how we can get more aggregated growth and more collaborative approaches to all this development and practices that we're trying to instill in even countries that are coming up. So we have a biannual analysis and analysis every time of our African economies. And one that stood out was one conducted by the World Bank, of course, that said that we have the continent's aggregate growth expected to rise to 3.2%, that is in this coming year, and 3.5% in 2019. Of course, reflective of a recovery in the largest economies. The reason why we say recovery is because, and I wish the MD of the Kenya Investment Authority was here, because we cannot talk about 2017 without people getting a headache. And we'll start off with the African Alliance on the same. 2017 was a tough year in Kenya, and I know Mr. Moria has been on the news on the same, saying that there are parts of the elements of the business that were hard hit. Millions of shillings were lost just primarily because of the caps, regulatory environment, the political environment. So there was a lot that went missing just based off of a particular year and a segment of our time in business. Now we have Africa's growth journey. When we take it across the border, it's not without hurdles. We have corruption, we have terrorism, at least in different parts of Africa, different cultures to understand if we're trying to move across the border. But now when we move together, there seems to be a lot more understanding of the language of business than we are accustomed to in the years before. So given that a bit of context, as we move forward, we'd like to start off with Mr. Alistair Gold. We've talked about 2017 being a year of headache. But from your point, seeing as you're within the investment banking space and you're with someone right next to you who has a portfolio that could have been hardly hit if things continued on the same trajectory, guide us through how investment was and how you've managed to patch things up as we map out the rest.
Thank you very much. Well, 2017 for Kenya in particular was a difficult year, simply because our electoral process has, over the last two cycles, brought in a lot of focus for the wrong reasons after our 2007 election. So investors tend to hold back around our election cycles, and 2017 was no exception. So the second half of the year in particular was lost to an electoral process that extended beyond our August election. Then we had the Supreme Court ruling, and a second election, and now we have a second swearing ceremony going on today. So it's not really over yet, and we wait to see what will transpire after today's events in Kenya. However, investors remain net positive about the whole continent, not just Kenya. Where we are, we see a lot of investors interested in sub-Saharan Africa as African Alliance. And I can say that there's a lot of interest despite the election. There's still a lot of positivity. African growth is faster than most economies across the world, so it's hard to ignore. There's still a lot of opportunities across sectors. So beyond 2018, I think we'll start to see inflows once again. All the people that were holding, that were on the sidelines now have an opportunity to create return.
Since we're still stock taking, Mr. Moria, I'll have to come to you. You mentioned around the end of last year, you mentioned that Centum posted about 1.6 billion for the half year 2017 compared to 2.1 billion. And you mentioned what I've touched on before, but there was a positive note because you mentioned the trading subsidiaries contributed over half of the group's turnover. So that means there was the glimpse of hope when all else within the financial scheme of things was not working. So just still to track back on the same conversation, patching things up and trying to work out maybe elements of your business that can hedge or give you at least some soothing as the damage is done.
I want to focus on something slightly different, is the positives in the economy in 2017. We grew about 4.8%, down from 5.8% in 2016. So that was about a 1% decline. Now, if you look at the reasons for the decline, they are multiple. Of course, there's the politics, and I leave those who are more experienced in politics, like Joe, to speak about it. He'll expound on the details of politics. But the other two major shocks that we suffered is, one, we had the worst drought in almost half a century, in 50 years. And it was not just in Kenya, it was in the region. And that affected the economy in a variety of ways. There was inflation. There was a food shortage, which contributed to a current account deficit. But also agriculture accounts for 25% of the GDP. So when you have 25% contribute of GDP that much impacted, tells you that for us then to grow at 4.8%, there are a number of other sectors that actually did very well. And I think that demonstrates the resilience of the economy. The second major shock was contraction in private sector credit. 2017 credit growth was only 2%. Contrast it with 2014 when it was 25%. So it was not just the politics, we had a number of other shocks. And the fourth one was that the regional economies also had a slowdown in their growth, and therefore our net exports to the region also slowed down. And despite that, we still grew. So when I look at 2018, I am positive because I think one of the variables that was there, which is a drought, I think that is not in play. The politics is likely to improve. If you look at the performance of the stock market since the official swearing in, it's done brilliantly. And also our foreign exchange reserves are perhaps at the highest point ever, with the Kenya shilling significantly appreciating, which tells you what the mood of investors is when they look at the country going forward. There's talk of removal of interest rate caps, and hopefully if that happens, then you might see a reversal of the contraction in the private sector credit growth. So my own view, looking at the economy in the medium term, is positive. Yeah.
Perfect. When you mentioned agriculture, I saw you scribbling, Mr. Gege, I saw you scribbling a few numbers there. But of course, now 2017, 2016, we saw a particular point in time, transitioning 2016-2017, where stakeholders in the flower industry met to re-strategize Kenya's flower industry in particular. And that's at a point when the whole economy was looking towards horticulture and all these exports being one of the main income earners for the country. So I would just like you to guide us still on the same, because we're trying to map out maybe opportunities for growth as we move on, how you worked out your numbers and whether the strategy helped over the last 2 years.
Agriculture does contribute the 25% to our GDP, and of that, 3% comes from horticulture, horticultural exports. And you'll be surprised that is only 4 to 7% of the production in horticulture that this country grows, 4 to 7%. And this is responsible 2016 for 70 billion Kenya shillings. And total horticulture, that's we broke the 100 billion line in 2016. Employing quite a few number of people. It's about 100,000 directly on the payroll, and those of us who are in related services and products, that brings us to about 500,000. So it is definitely a key contributor to the economy of this country in more ways than one. You also see that because of the export horticulture, we have also somewhat changed the way we produce our own food. And that when you walk around the country, you will see people adopting new technologies like growing greenhouses, having water reservoirs and using irrigation, generally adopting technology. And so this is very positive when we start to look at food security and we begin to perhaps diversify our diet from the traditional food that we have used over the years to accommodate more faster growing, more nutritious foods, dare I say. But having said that, definitely the impact of the politics of this country is very key to this industry. Remember that there are loads of people watching Kenya, and it is really the image that sells our produce. People out there want to see that we have a stable country. They want to see that our people are happy people. And over and above the other normal challenges we have out there, for instance, the international trade protocols like the Economic Partnership Agreement, or indeed the impact of Brexit on what happens there. So people are watching Kenya, and we are the #1 supplier of flowers into the EU, providing, believe it or not, 40% of all the flowers that are imported into the EU. #1 exporter into Japan, which is a very fastidious market. #1 supplier to Australia. What am I trying to say here is that there is a huge potential in terms of horticultural production in this country. There is even a bigger opportunity to coalesce the region, not to just look at Kenya, but to look at what can East Africa do, what can Eastern Africa do, including Ethiopia there, what can Africa do in terms of being able to supply the world with horticultural produce or other agricultural produce. Remember that we have this diversity of the geographical settings. We have the numbers and very young people too. So we have a huge potential, and it's very pleasing to see places I've been to, young people asking questions about agriculture, about horticulture, so that we are assured that, unlike other places in the world, this part of the economy is going to grow and not sort of age out.
Did we ever get past the conversation on Kenya lacking distinct features at the European auction? Because I remember there was a big conversation at some point where we wondered whether we would match international standards when we were making so much money exporting.
Yeah, what an interesting question at that point in time. As I mentioned, we're the #1 supplier into the European Union. And one of the reasons is because challenges that have been put in place against the producers in this country have actually led them to improve their standards so that they can meet the customer requirements or the expectations of this little third world country in the middle of Africa. And I take a lot of pleasure and pride in saying that when you look at our standards of our flowers, the environment within which these are grown, our standard is now one of the most robust standards compared to others through the International Trade Center, not by ourselves, International Trade Center. So we have one of the most robust standards for growing good quality roses.
When we first had the news of an acquisition as part of a buyout spanning 10 AON units in Africa, we were curious about how keen the company was in developing in some of the already advanced economies in different regions. Particularly, we were looking at Kenya, Ethiopia, or others around the continent. And now for Kenya, 90 days so far. And we'd just like to understand how deliberate it was, given the particular time. Of course, we've had the different scenarios, and how the uptake or the market response was.
The divestiture of Aeon from Africa was a very deliberate and well thought out strategy of the Aeon group, where they looked at various markets across the world, not just in Africa. They looked at markets in South America, in Eastern Europe, and where they felt that at that particular time there was not enough scalability in some of these markets, particularly given the tighter regulatory environment in the home markets. They felt there might be a different and more efficient way of engaging in those markets without necessarily having equity participation in the companies operating those markets. So given that, they decided, why don't we sell our equity in some of these markets and replace that equity participation with a correspondent agreement that will give us as much access to that network as we had before, and that will give the new entity as much access to some of the support we got from the Aon Group, which was significant. You're talking about 50,000 professionals around the world, experts in different fields that our teams in Africa can collaborate with. You're talking about huge investments in research that Aon had, to which all our staff in Africa had access to. So all those things were retained under a correspondent agreement with the new entity. Aon sold its shares to an African private equity firm with management. And in a sense, we feel we are getting the best of both worlds. One of the things this has afforded us is a lot of agility to move quickly into opportunity areas in Africa. And there are many opportunity areas emerging for which a global multinational might have blind spots. And decision-making might be a bit more slower. So in that sense, we retain a lot of what was best about being Aon, but at the same time acquire a new level of agility, flexibility, and quicker decision-making in the markets. So far, you asked, how has it gone down? It has gone down very, very well. Fortunately, even before Aon, we had a very robust organization across the continent, which is the name we went back to, Minet. So in a lot of the markets, people knew Minet. The Aon brand was very, very strong, particularly after their sponsorship of that football team, Manchester United, of which I know there are some supporters in the room today. But the brand was very strong. And in our new identity, we've tried to retain as much of that identity and that connection as possible. But I think, as I said, it has gone down well. We launched in 6 countries in November. We expect to launch in 4 more this quarter, and then complete the whole transaction before the end of the year by completing the remaining country, which will be Botswana. And that will give us a network of 12 countries across the continent and places us in a very prime position to serve particularly clients who are operating across borders.
Let's see who we are trying to bring on the table as you map out your trajectory, right? You mentioned at the time when we were seeing that in Capital Works and they were in the news, they had about more than $550 million in assets. That's about 53.4 billion Kenyan shillings. Now, for that particular asset base, you would want a potential clientele or someone who you do the hand-holding with to reciprocate the asset base or related financially. So how much room is there to grow with different segments of the markets, SMEs, smaller businesses?
There is significant room for growth, and that's why I mentioned the one thing you need to be able to exploit, like you mentioned, the SMEs and the middle markets, is good products, efficient distribution, and an efficient service fulfillment model. In this day and age, that requires investments, particularly in IT, in digitalization, to make it possible for you to actually get your products there in a cost-effective and efficient manner, which brings the agility into it. Right now, we feel we have a bit more flexibility to use our own understanding of our markets and choose the right investments to help us tap those markets, like the SMEs. We still remain big players in the big investments that come from abroad. There's significant investments in infrastructure, road, rail, and energy. Some of those, again, tend to be by multinational, either the companies or the guys lending them, who have investments in various parts of the continent. And they want to work with someone who understands their requirements and has experience working with their sort of investments. So we still remain, in all our markets in Africa, the strongest in those areas, the big investments coming from outside. We've also seen over the last, say, 10 years, companies that started out in our middle market segment or SME segment, but because of real growth in their business, they have grown significantly. I mean, some of our biggest customers are actually local customers who started out with us small, grew big, and now run operations in more than one country. We have clients that started out as banks in Kenya and now have a network into Sudan, Rwanda, Uganda, and that kind of thing. And we expect going forward that will be actually the growth sector in our business. Yeah.
Okay. Mr. Moyo, still on a similar point, now going back to your finances, you reached a point when you were extending your investment portfolio, and we saw that over the last 3-4 years, you had finance costs all the way up to about 208% year on year. So that means that your investment portfolio was moving at a pace that other companies at the same scale had not anticipated or seen before. Now, in terms of who you got on the table, we saw about 1.4 billion at some point in terms of equity funding, but we'd like to know what financing models you were looking at and who you were looking at to partner, whether locally or internationally.
Over the last 5 years or sort of maybe 6 years, we've deployed in excess of perhaps maybe 50 billion shillings in various investments. And we've applied a variety of financing models. We've had successful companies, like Joe's company that we've sold at a profit, and those have gone on to sell at even bigger profits. So that has been one of our financing model. The most successful model that we've employed is in developing ideas from scratch and building businesses of scale, and then bringing on board other investors to participate alongside us at a value uplift. And we've done that successfully in our real estate business, where we've raised in excess of $200 million over the last 4 years through various equity raises. And our preference has been equity as opposed to debt because of the long-term nature of those projects, and you don't want to be saddled with too much leverage, especially because one is never sure how the cycles will pan out. So for some of our projects, if we had funded them with debt at the time, yes, we would have kept a greater degree of equity, but today would have been under significant strain. And I think for me, my major lesson from 2017 is that it's very important not just to build a growth business, but also to build a resilient business, because you never know what shocks you're going to come along the way. And the thing I always tell my team, expect shocks, and therefore it's our responsibility to give ourselves sufficient buffer to withstand whatever shocks come along the way. In 2014 and 2012 and 2015, we went to the market and raised capital through the capital markets in the bond market. And at that time, the bond market was very active. Unfortunately, because of what has happened subsequently with the banks that went under in 2016, that had raised money through the local bond market, we've not seen successful bond issues coming up. And so recently, when our own bond matured, the 2012 bond, we had issued a bond of $50 million in 2012. It matured in 2017 last year. The worst of times. It matured in August, 1 week or 2 weeks after the election had been postponed, and therefore you couldn't go back to the market to raise capital. We had to refinance it internally. So we're not able to go back to the market. So we had to refinance it internally. We've also seen growing interest from international lenders who are coming into the market with long-term debt capital in hard currency. And here we must give credit to the central bank for having a fairly stable, keeping our exchange rate fairly stable. So, and of course, then you have the domestic bank market that we work with for our financing. So you then have a variety of funding sources. One thing I can say is that what my experience has been is that there's more capital still looking for opportunities in our region than there is quality investment grade assets of scale. So there's still that mismatch, and as long as you're able to supply quality investment grade assets of scale, it will be there's capital available to us from across the globe.
why do we need to convince international conglomerates to come, right? When we have the market, the consumer base, the segmentation, we have the commodities, we have the bankers, the investment bankers, the actuaries, and one of them is seated right there at the end. So I'm sure you've experienced this conversation, and I know we'll get into the AU and what they've done with the self-financing mechanism, but has this been a point of concern, trying to get a regional conversation as opposed to Kenya while still pushing a Kenyan agenda?
Well, yes, this has been a concern. Unfortunately, a lot of Western countries see Africa as one country. So they see Africa as one place. That's in some way our doing. But I think we as Africans also need to be a little more united and show what a strong front one Africa can be. The challenge for a lot of foreign investors is scale, as James has rightly put it. Finding quality investments that are of a decent size that can make a meaningful contribution to their larger portfolios is the challenge here. So as much as there may be willingness, and there is a lot of willingness from across the globe to invest in Africa, there just aren't investments that are the right size. If you're talking about a $100 billion fund that's looking for an opportunity in Africa and wants to deploy 1%, it's hard to find 1, 2, 3 businesses that will take up that capital and deploy it usefully and generate a meaningful return. So I think the challenge here is that a lot of our businesses fall in the SME kind of categories. Even in Kenya, that's where a lot of people are employed. Small, medium-sized businesses, and those are what need to scale up. That scaling up, I think, can be done locally and from local capital to get them to a point where they can attract a lot more international capital.
Within the horticulture industries, there are a lot of variables, but it all points to one specific point. So what aspects for growth would you be looking at, and who would you look to?
Aspects of growth in the floriculture industry, learning from the market intelligence that we have, is that we have a 5% growth in international demand for flowers year on year. The big question is what chunk of it, or what slice of it, can come to Kenya, can come to the region. And this will all depend on the kind of capital infrastructure we have in place and the kind of innovation that we can bring about. I mentioned, for instance, that what I am seeing happening now is that countries in Europe have identified this as a good destination for investing in horticultural products. One that surprised me most was when a significant representative of one of the embassies talked about, believe it or not, the florists, the nurseries, the roadside nurseries, is a potential area for growth. They see the diversity of products there. They see the potential of developing those products into even exportable products. They also look at what kind of services can they bring to this country? What kind of products can they bring into this country? And now the Chamber of Commerces from a lot of these European countries are really scouting for opportunities to bring products, services, and their governments are working with them in terms of supporting them. And they're not even looking at the kind of funds you're talking about, but they're making very definite inroads into the products and the service provision part of this business. And one of the areas that perhaps we need to do quite a bit of exploration is in the area of risk management. These are biological assets, and yes, we had ATI at some point, but the level of technology that is coming in, the level of complexity of the logistics, the level of demands in the marketplace demands that we begin to look at how do we support this industry in terms of the kind of investments we can inject. I'll give you one example, for instance. Well, right now we're grappling with the whole concept of Europe protecting its environment to make sure that harmful organisms and diseases don't get into their space. And so they're asking us to send almost sanitized produce into those markets, almost sanitized products into those markets. Now, where do we find the technology, where are we going to get the money to put up fumigation chambers and the logistics that go along with it. And the farmers are just like, okay, we know how to grow flowers, but these kind of things that you're talking about. So these are the areas of growth that I see in terms of the logistics and the services. I see the other area of growth as in the diversity of markets. Yes, we are mainly destined to the European market, geographically situated very well for ourselves. But we hope that the direct flights to America will give us a chance not to compete with the South Americans who provide North America with flowers, but to provide a niche product, which is very different from the South American product. The South American product is a big flower, top heavy. I call it a cabbage because it's so big. And ours is tighter, tighter and therefore lasts longer. So we'd like to get into a niche market. What would stop us from becoming successful there? Do we have commercial presence? Do we have a destination where we can bulk the products that come from the various parts of East Africa so that the assortment can provide a good bouquet, diversified bouquets for different functions and occasions? China, they're the biggest growers of flowers in the world, but they consume all their flowers and the quality is, let's not talk about it now. But this is a very ripe market for us. And in fact, what is happening with the European strategists in this business of flowers is that they are building the infrastructure themselves from Holland to be able to cater for quality flowers. Right now, they sell their flowers, on walkways and stuff like that. But they're building this, what I call the commercial presence. As Africa, where are we going to be left by that development when we are not stepping out to create that very strong presence? So in terms of other developments, what is our assortment? If we can't have the widest assortment here in Kenya, we can certainly source from South Africa, we can source from elsewhere and accumulate that product here in Kenya. And I know this is a big dream, but there's no reason why Kenya cannot become the Holland in the future, where flowers are bulked, where flowers are assorted and then sent out to the rest of the world.
We know that as your company, you normally engage most companies at the inception stage. You're there advising before they execute. So, for example, in that particular scenario with the horticulture industry, where exactly do you think you would come in, maybe as an advisory role? Also, we'd like to hear your comment on the technology bit. We are particularly curious about how much went into innovation and the digital scheme of things when the money was being pumped in to execute country by country with Minet.
In terms of the agriculture or the flower business, what help we can do, and you mentioned de-risking business enterprises for investors is basically what we do. Whether we do it by risk transfer, whether we do it by risk management or risk engineering, this is what we do. And you're right, for the really big investments, we tend to get involved, like energy, rail, and stuff like that. We tend to get involved long before even the market knows this investment is being made, because the person putting up the money wants to make sure that all the risks that can be removed or transferred or minimized are done before they commit their money. So we do get involved at that early stage doing studies, risk studies, where the weak points are, what the maximum probable loss can be out of any given event, and that kind of thing, so that we are able to assure the people putting in their money that those risks that can be managed and mitigated are managed and mitigated, and then they can invest and wait for their returns without any unexpected shocks. In the area of flowers, we have a very big agricultural practice in the Netherlands, Aeon Agricultural Practice, with whom we collaborate, and they insure a lot of the flower industry in Holland. And if we were to understand where the interventions are needed locally, I'm sure we can put together a team. And the teams we put together are not necessarily from Kenya. Our teams are actually transnational, multinational. We can get people in to look at where the interventions are needed and give suggested solutions, given their experience in the areas that maybe we don't have too much, in the more technical areas that we don't have too much expertise over here. So that is the sort of thing that we do very well.
It's now time for a short break. We'll be back with a bit more discussion on the same, but just to make sure that you don't change the channel. Of course, this is very timely in regards to the African Union, and we've seen a new chairperson take over. This is after the conversation within the US and the World Trade Organization that any conversation on a 0.2% levy on a self-financing mechanism will be breach of the World Trade Organization. So when we come back, we'll take a look at prospects for self-financing, but within a local context. And when we say local, we mean inside Africa. So we'll be right back right here on CNBC Africa. Before we left for the break, we had mentioned on this particular aspect of the self-financing mechanism within the AU, and I'd like to hear from you because you advise on most of these financing models. So there was that issue on the breach and a 0.2% levy, which we were also doubting because we've also not met most of the targets that we've set for ourselves within either the Legislative Assembly or our East African buckets. So when you hear such a conversation, what comes to mind, especially when we're trying to push an agenda that we're saying Africa needs to be built by Africans?
Well, I mean, it's true, but each country, each member is going through its own internal challenges. A lot of us are in deficits as economies year after year. But the fact is we need to promote the growth that's going to emanate from this continent. And all the member states are better placed being involved in this growth story. One place that a lot of us can benefit from as individual countries is through the sovereign wealth funds, and those have contributed a lot to growth in the more developed countries. And setting up proper structures around how those finance opportunities in Africa, I think, is going to be the way forward for the rest of Africa.
I think several facts is that Africa is perhaps the one region in the world that trades least with itself. And within Africa, East Africa is one that is doing the best. And so why is this the case? I think there are several reasons. One, majority of us produce the same commodities with very limited value addition. So there's little need for, say, Rwanda and Kenya to trade in coffee because we're both producing the same products. Now, for us to trade more, we need to change the composition of what we produce, go to value addition and manufacturing. Now, manufacturing is a game of scale. You don't manufacture if you don't have enough scale. It doesn't make sense for you to manufacture. Now, because the economies are small, it would make sense if there was greater trade amongst ourselves that would then give greater scope for manufacturers to come and set up. If a manufacturer, say when BMW was going to China, what they did, they went up and set up a plant in China. So ask yourself, how come you don't have enough manufacturers who want to target Kenya, African market setting up in Africa? The reason is because there's little incentive for them to do so. Because the way each one of us has negotiated our external tariffs, there's no incentive for you to manufacture within Africa. It is easier for you to export to Africa. And therefore, until we sit together and sort out our external tariff, and one of the challenges we faced when, for instance, we're negotiating the East African Common External Tariff is because Kenya, Uganda, Tanzania were at different stages of development in their manufacturing sectors. A lot of the other countries that are at a lower level were pushing for lower external tariffs. And what that does is that it makes the whole region uncompetitive in terms of setting up manufacturing industry. The thing for us to remember is that now we are not competing with ourselves. We are competing with the rest of the world, and the cost of shipping have come down significantly. So even as we address the issue of how we trade amongst ourselves, how we set up infrastructure and the rest, if we are to go up the value chain, it's important for us also to understand regionally how we engage with the rest of the world. Now, to your point on AU, it is interesting that now when the AU tries to raise money internally, it is considered anti-competitive. You may have seen the story the other day where the AU headquarters in Addis Ababa was built by one of our benefactors, and for 5 years they were listening in on to our conversations. So all those are interesting points for us to ponder. I think it's important for us as Africans to think more for ourselves, rather than, you know, we sometimes we're good at implementing ideas that have been manufactured elsewhere without sufficient consideration of what the implication is for us in this part of the world.
Now, we've always been curious, Ms. Ngeye, you'll allow us to just put you on the hotspot for a bit. We applaud the progress that has been made trying to create an international market, but we've always been curious about the feasibility studies conducted on ground to see just how large the market, or if you were to allocate resources for the African market, how large would that market be? Or how long would it take us to actually build one in Africa for the horticulture industry?
Perhaps where we should begin as Africa is to look at where do each one of us have a competitive edge. If you look at the horticulture industry here, we are now importing a lot of our horticultural products from countries like Tanzania, onions and tomatoes, pineapples from Uganda, because it's too expensive to produce them here. We struggle to produce enough maize for ourselves. Should we be grappling with the whole idea of growing enough maize here, or is it more does it make more sense to grow it elsewhere? For instance, in Uganda, where they can do it so much more cheaply than we can. And I think we need a conversation to see who has what edge in this part of the world, and how can we promote that, that opportunity to be able to produce whatever they can produce best, perhaps through looking at strategic environment assessments for the various crops that we can do, looking at our technological development to see what markets we can service, but also looking at the logistics in terms of how we can move around products. Maybe we should be moving maize around the region much more than just trying to grow it here. We had a story the other day about banning avocados coming from Kenya. The real reason was that we were beginning to sell avocados before they were ripe for the market. Maybe we should have a conversation around who should be selling avocados at what time in the year from this particular region. Those are the conversations I think we should be having. In terms of what each country can put onto the table. If you're talking about manufacturing, if you're talking about exports, it's amazing that we as Kenya can excel in export horticulture. And I mentioned we only export 4 to 7%. And yet we have issues of feeding ourselves. That's something, it's something I've never been able to understand. How can we excel in exports of horticulture and yet we are a hungry nation? There must be something we're not doing right. The market must be there. We are told that the value of the Kenyan horticulture market is about 300 billion in total. But what happens to 40% of that? It goes into waste because we lack value addition. It's good to see what is happening now in places like Makueni, and I think devolution is one of the best things that has happened to this country. You now see that in Makueni they have a big plant for processing mango. Hopefully this can grow and become like a focal point for high value mango. In other words, I'm saying, can Makueni import mangoes from other counties so that they provide a stable product that doesn't have the seasonal variation because it's just coming from one center? That's an example. We have another plant coming up in Thika, and they're processing potatoes, carrots, and peas and beans. This is the kind of thing that we should be looking at, and to see how we support this, because even our local customer is dynamic, is changing. They're looking for convenience. They're looking for diversity. They're looking for exciting, products. And mukimo is no longer the best dish on the table. Let's face it. And hopefully nyama choma will also take a sidewalk. So the market is there. The young population that is coming in is demanding innovation. we need to respond to that innovation. Regulation really should be helping us to produce safe, quality, and quantity of food to cater for this population within, of course, East Africa, but beyond, and also take advantage of the variety or the diversity of products within the continent. It's a bit sad when you travel and you come across Indian cuisine, you come across Japanese cuisine, Chinese cuisine. What do you see from Africa?
10 years ago, we had all these multinational companies that would come, and those are the ones that we knew. And they could easily come into the continent and go East Africa, West Africa, South Africa easily. They understood, or they could deploy and burn and not worry about that. So you're now looking at East and Southern Africa from your perspective. What would it take, at least structurally, for you to penetrate even West Africa or a huge pan-African presence as seamlessly as possible?
Not very much, actually, because you're looking at the network that we control and own, which is in the 12 countries that we talked about. But through technical agreements, we can place business across all 52 countries in Africa through, again, partnerships, correspondence that we've worked with for very many years. We have clients in Nigeria, Ghana that we can actually service. Our intention, though, is to actually grow the owned network, and one of our immediate targets will be West Africa, because it houses some big powerhouse economies. Nigeria is large. Ghana is growing very well now after the shock they had a few years ago. They've recovered and they're doing well. So those are markets that we intend to go into. Some other markets were kept out of because of regulation. Ethiopia is difficult from a regulatory viewpoint in the financial services. The DRC, up until recently, same likewise. But DRC is relaxing their regulation, which will make it easier for us to be there. There's a lot of mining activity there. There's already a lot of clients who we are servicing or are related to that are doing business there. So we'll find business there when we do go. Ethiopia is also relaxing, or they've been talking about relaxing their barriers to entry in the financial services there. As soon as they do, we do our partnerships there, and it won't be hard to go in this. Getting into the markets won't be hard because we have partnerships, and we have clients that are regional or multinational in nature that know us already. So that is definitely our focus over the next 3 years, to expand this network, because we believe, despite all the problems that we've posed to intra-Africa trade, we believe that these are problems that are being addressed and will be solved, and this is where the future is. We do have to grow that part of the business, as someone mentioned. Basically, we have to trade more generally, whether within each other or even externally. But the easier touch point is when we are only doing less than 10% of trade within African countries, where the global benchmark, even in South America and places like that, is closer to 40%. So you can see there's a lot of headroom there, and as well, there's been successes. I mean, let's not overlook the successes. Look at Kenya, for instance, where if you were talking 15 years ago and you talk about the largest banks in this market were the multinational banks. You look at it now, it's been turned the other way around. Local banks are leading the way in innovation, in market share, and even in regional expansion. We have financial institutions expanding quite quickly from West Africa. West African banks, you find them in Mozambique, in all these places. So it's happening, and we believe our focus in growing our network across the continent, we're making the right bet, because our fortunes follow the fortunes of our clients. And we want them, when James is opening up his agriculture processing plant in Mali, we want him to find Minet waiting for him.